The gold and silver sell-off. What actually happened? Gold and silver experienced a sudden and sharp sell-off, erasing a significant portion of recent gains in a very short period of time. Prices fell rapidly, triggering volatility across futures markets, ETFs, and mining stocks. This move followed a period in which both metals were trading near multi-year or record highs after months of strong inflows driven by inflation concerns, geopolitical risk, and expectations of easier monetary policy. According to market data, the decline was accelerated by heavy positioning and leverage in precious metals futures. When prices began to fall, stop-loss orders and margin calls were triggered, increasing selling pressure and reducing liquidity. This type of move is not uncommon in highly liquid, leveraged markets when sentiment shifts quickly. At the same time, markets were reacting to political and monetary policy developments in the United States. Donald Trump publicly discussed potential changes to the Federal Reserve should he return to office, including naming individuals aligned with a more inflation-focused monetary stance. Among the names discussed in financial media was Kevin Warsh, who previously served as a Federal Reserve governor from 2006 to 2011. Warsh is widely known for expressing concern about inflation risks and for criticizing prolonged accommodative monetary policy. While no policy changes occurred, markets responded to the possibility of a more hawkish future Federal Reserve. As these expectations shifted, U.S. Treasury yields moved higher, and the U.S. dollar strengthened. Both developments historically place pressure on gold and silver, which do not generate yield and are priced in dollars. With positioning already stretched, the change in macro expectations was enough to trigger a rapid unwind. Importantly, this move did not reflect a breakdown in the underlying function of gold or silver as assets. Instead, it reflected a repricing driven by positioning, leverage, and changing expectations, rather than fundamentals such as physical supply shortages or demand collapse.